Welcome to CoreLogic's monthly housing market update for August 2016. Earlier this month, we saw the Reserve Bank cut interest rates for the second time this year, taking the cash rate down to a historic low of 1.5%. The rates decision came a day after CoreLogic reported a further slowdown in the rate of growth across the housing market. While dwelling values are still rising, importantly, the annual rate of growth was the lowest since September 2013, highlighting that housing market conditions appear to be softer than previously thought. Dwelling values moved higher in July across 4 of Australia's 8 capital cities, and they fell across the remaining 4 cities. Perth and Darwin continued the downwards trend that's been evident since 2014, while Brisbane and Canberra values also dipped lower in July. Darwin and Perth remain as the only capital cities where dwelling values have shifted lower over the past year. At the other end of the spectrum, Sydney values are up by 9.1% over the past 12 months, and Melbourne values have shifted 7.5% higher. While the annual trend in dwelling value growth remains high in Sydney and Melbourne, the trend is tracking at about half the annual rate of growth compared with the recent peak rate of growth recorded last year. Several other indicators are also suggesting the housing growth cycle may be losing some steam. The number of dwelling sales has been trending lower during 2016, with the number of home sales across the capital city showing a 13% year-on-year decline. Dwelling values are starting to take longer to sell, with a typical capital city home averaging 47 days to sell compared with 42 days at the same time last year. Outside of the Christmas and New Year period, this represents the longest average selling time on market since August 2013. If the average selling time continues to trend higher, we would expect discounting rates to also rise, which is likely to help easing some of the upwards pressure on dwelling values. Another indicator of slowing activity can be seen across the CoreLogic valuation platforms. The CoreLogic Mortgage Index, which tracks mortgage activity across proprietary platforms, was 8.6% lower in July and 3% lower year on year. This indicates that demand for mortgages eased in July following a fall in June. Auction markets have bucked the slowing trend though, with auction clearance rates gaining some ground during July. In Sydney, auction clearance rates have been above 70% for 15 consecutive weeks, reaching a preliminary clearance rate of 80% over the last week of July, while in Melbourne, clearance rates have been above 70% for each of the past 4 weeks. Importantly, auction volumes are currently much lower than they were 12 months ago. With investment in the marketplace still a large source of mortgage demand, it will be important to monitor investment appetite for housing. Investors still comprise 47% of the value of housing finance commitments, excluding refinance loans. The most recent housing credit data has shown that investor housing credit has increased by just 5% over the past year, its slowest rate of growth since March 2012. Tighter serviceability limits and a recent crackdown on lending to investors from offshore has resulted in a fall in demand from the investor segment of the market. The data indicates that there's scope for lenders to increase the lending to investors. However, it does remain to be seen as to whether or not there will be any significant uplift in demand from this segment of the market. Investors may progressively look outside of the 2 major capitals, but they're likely to be cautious about the potential for oversupply in the apartment markets, as well as low rental yields due to soft rental conditions. With interest rates coming down in August, policymakers and regulators will be keeping a close eye on the housing market. There's already an indication that the cash rate cut won't be passed on in its entirety to mortgage rates, which should help to minimise the chances of a rebound in home value appreciation. Additionally, pre-existing affordability barriers, higher supply levels, low rental yields, and a more cautious lending environment are likely to dampen the trend rate of capital gains further. As always, thanks for tuning into the CoreLogic overview of housing market conditions. There's plenty more research and housing market insights at our website located at www.corelogic.com.au.